All right, let's dive straight into this explainer. Today, we're putting on our equity analyst hats to build a rigorous discounted cash flow model for AST Space Mobile from the ground up. We're basing everything here exclusively on their latest financial disclosures, 8K filings, and solid industry data. Because, let's be real, if you want to understand the true intrinsic value of a pre-profit hyper-growth space company, you absolutely have to cut through the hype and look strictly at the numbers.
Here's our roadmap for the analysis. We'll start with the business model and moat, move into financial reality and liquidity, derive our free cash flow, calculate WACC and cost of capital, lay out our forecast and terminal value, and finally wrap up with our intrinsic value conclusion.
Section 1, Business Model and Moat, the space to sell race. Pulling directly from the management's discussion and analysis section of their latest 8K, we see a massive leap. AST went from just $4.4 million in initial revenue in 2024 to a staggering $70.9 million in 2025. That ramp-up was heavily driven by U.S. government contracts and global gateway deliveries. But looking ahead to 2026, things get even more aggressive. They're targeting 45 to 60 of their Bluebird satellites in orbit by year-end to establish continuous global coverage.
Now, when assessing their qualitative moat, it really is a classic tortoise and hare scenario. SpaceX's Starlink has a massive head start. They already have 349 direct-to-cell satellites launched. But the current tech is strictly limited to SMS text and requires a clear line of sight to the sky. AST's underlying Block 2 tech, on the other hand, it's a whole different beast. It boasts roughly 100 times the capacity per satellite. We're talking technology that can penetrate trees and even reach indoors. Plus, according to their corporate filings, they've already secured partnerships with over 40 mobile network operators. We're talking giants like AT&T, Verizon, and Vodafone.
Digging into the business description section, their intellectual property is fascinating. AST holds 176 patents globally, with 96 already granted. The U.S. serves as their primary R&D hub, and this robust patent portfolio is exactly what cements their technological barrier to entry against any competitors trying to replicate this kind of space-based broadband network.
Section 2, Financial Reality and Liquidity. High growth, high burn. Stepping into the 2025 Consolidated Statement of Operations, we get a stark reality check. Yes, they had a massive revenue surge, but it was entirely swallowed up by heavy operational expenses. Total OPEX ballooned to $358.6 million, primarily driven by massive engineering and administrative costs. This resulted in a net loss attributable to common stockholders of a whopping $341.9 million for the year. This right here is the textbook definition of a high-growth, high-burn phase.
If we segment out that $70.9 million top line based on their revenue recognition notes, we actually see a pretty healthy split. $44.3 million of that comes from tangible gateway product deliveries. They successfully delivered 15 gateways across 5 continents. The remaining $26.5 million comes from services revenues, which are largely tied up in those highly lucrative U.S. government contracts.
So, the absolutely crucial question is liquidity. How on earth do they survive this burn rate? Well, checking the balance sheet notes, they ended the year with $2.8 billion in cash and restricted cash. But pro forma, accounting for that massive $1.075 billion 10-year convertible notes deal detailed in the subsequent events, they actually have total liquidity of over $3.9 billion. This war chest is what gives them the necessary runway to fund their incredibly capital-intensive 2026 launch schedule.
Section 3. Deriving free cash flow. The forensic bridge.
Okay, let's build our bridge directly from the statement of cash flows. We start with a net loss before non-controlling interest of negative $461 million. Then, we add back our non-cash charges. That's $51.1 million in depreciation and amortization, $47.4 million in stock-based comp, and a $68.1 million loss on warrant liabilities. But here's where it hurts, the massive deduction. $1.06 billion in capital expenditures for property and equipment. That leaves us with a heavily negative baseline unlevered free cash flow of negative $1.35 billion.
Section 4. WACC and cost of capital. Grounding the assumptions.
To discount these flows, we need our cost of equity using the capital asset pricing model. We're pulling a highly volatile beta of 2.60 directly from MarketBeat. Since the filings obviously don't provide macroeconomic inputs, we're plugging in sensible external assumptions. A 4.5% risk-free rate reflecting current long-term yields, and a standard 5.5% equity risk premium. Run the math, and we get an 18.8% cost of equity. This aggressively high rate makes total sense. It perfectly reflects the extreme execution risk of deploying a massive space constellation. Next up, our pre-tax cost of debt. Taking the $36 million in reported interest expense over their roughly $2.2 billion in net debt gives us a surprisingly low 1.6%. For taxes, we're applying a 0% effective tax rate, which is standard given their massive accumulated deficits. Now, thanks to their surging stock price, equity makes up 93% of their roughly $31 billion enterprise value, leaving debt at just 7%. Weighting all of this out gives us a final, rigorous WACC of approximately 17.6%.
Section 5. Forecast and terminal value, the growth premium.
Our DCF model explicitly maps out the ramp to 60 satellites by the end of 2026, assuming 1 to 2 launches monthly. We project that capital expenditures will finally start to normalize once their initial gross property investment of $1.6 billion is fully deployed. To make the model work, revenues have to scale rapidly by converting their stated $1.2 billion contracted revenue backlog into actual recognized income. And finally, for our perpetuity value, we apply an external assumption of a 3% terminal growth rate, which aligns with long-term global GDP expansion in their target mobile markets.
Section 6. Intrinsic value conclusion. Let's see what the math tells us. Balancing that intense $1.35 billion current cash burn against a massive $1.2 billion contracted backlog and technology that boasts literally 100 times the capacity of Starlink, what does our rigorous model actually output?
While our DCF output indicates that at the current market price hovering around $75 a share, the market is already pricing in near-flawless execution. The intrinsic value is incredibly sensitive, heavily depending on them maintaining that $3.9 billion pro forma liquidity without needing any severe future equity dilution. To justify today's valuation, AST SpaceMobile basically must successfully launch and activate their full 243 satellite network by 2028 with zero major setbacks.
I'll leave you with this final thought, straight from CEO Abel Avilan in their latest 8K. The ultimate valuation tiebreaker isn't just the math we ran today. It's whether they can successfully turn a massive capital burn into an active, globally adopted commercial service this very year. The stakes are literally as high as the satellites themselves. Will they win the space race?